Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. I'm going through the comments section here. I wanted to answer one of these questions. It says, I'm confused about the thesis on real estate and interest rates. Namely, when interest rates go up, the dollar rises. This kills gold and silver. When interest rates go up, real estate drops due to higher mortgage rates. When interest rates went up a few months ago, gold and silver dropped like a rock. Real estate is going into its slow time of year. Real estate inventories have been steadily rising several weeks in a row. Given all this, I'm wondering why the thesis that real estate is booming will trigger a wave into commodities, and rising interest rates will drive up gold, silver, and other commodities. This all seems self-contradictory. Any help understanding is greatly appreciated. So the thing that you have a couple of things here that I don't think are necessarily facts. So when you say when interest rates go up, the dollar rises, that's not a fact. In fact, I think the way that you want to see it as when the dollar declines because from inflation, interest rates go up to support. How can I say this? I'll back up. This is. I'm going to start from the beginning. Demographics, a larger demographic, usually is the first phase. So you have a growing population. That growing population goes into home buying years. When they go into home buying years, what happens is that there's going to be a supply versus demand imbalance. Prices are going to rise to a point where the people are going to look at the homes and say, I'm going to go buy a new house. It is economically justifiable to buy a new house versus an existing house because prices are going to go up high enough where people are going to decide to buy a new home. And what that does is when the demographics get large enough, when there's a large enough supply-demand imbalance, and there's too many buyers for too few of homes, home prices start to rocket higher. People will choose to buy more new homes. And what happens is more new homes get built as the demand for new homes increases. And what happens is we go into an expansionary phase of real estate. What that is that more new homes are going to be built over the long-term average to satisfy the demand from the growing demographic in home buying years. And that's where we are at today. The millennials are a larger demographic in home buying years coming up and buying more homes. And that's why you're seeing home prices skyrocket and new homes are starting to get kicked on. And this is what the new housing starts for residential single family homes. The baby boomers were this period in this red box. That's the baby boomers. We had another underbuilt scenario here where we had to go in and build some more, but this was a false signal because these were buyers with bad loans. They were giving loans to everybody. So they fictitiously created demand and created this bubble. Now we've got the millennials coming up in home buying years, going into an expansionary phase with a jacked up supply demand balance over here. We underbuilt by 3.8 million homes in the real estate market in this big area under the curve here, under this average. The red line's the average, and we didn't build all these homes. And now we have a huge imbalance of supply and demand. And that's why our inventory is completely eaten up in real estate. That inventory that was eaten up is going to kick on a housing expansion phase that we're entering right now where the star's at. And we're going to see home builds go far above the average, which is an inflationary period. This was an inflationary period. This was a small inflationary period. And I think we're going to see an inflationary period come where we get new loans against new homes, which is inflationary because these loans are creating money in the system against a new asset that didn't exist beforehand. That is 100% inflationary of that loan. The red stars are where I put a commodity buy signal. And all that is it's a commodity index versus the S&P 500. It's an asset versus an asset. When commodities are cheap, you'll get a low number. It's the green signal circles here. Those are signals to buy commodities. The red is when commodities become expensive against stocks and you want to sell them or rotate out. So we've got those signals there that are happening right now, and they've always aligned at the beginning of an expansionary phase of real estate. What happens is the first step is the demographics come, a larger demographic. We go to an expansionary phase. That is inflationary. It's what you've looked at history. If you look at history, you're going to see that these expansionary phases are always inflationary. Inflation is going to put pressure on bonds because what happens is inflation goes up and your interest rates are low. It's going to put a real negative rate on bonds. It means you're losing money if you own bonds because the inflation rate is higher than the interest rate that they're paying you. So if you have a 5% inflation rate and a 2% interest rate on your bond, you're losing 3%. It's a real negative rate of minus 3%. I'm losing 3% in my bonds. So what do the bondholders do? They sell their bonds. When people sell bonds, it puts pressure on interest rates to go up. So interest rates go up under an inflationary environment, a higher inflationary environment. So as we get more and more inflation into the system, because we're short homes, we're building these new homes, we're putting all these new loans into the system, and all this money's being created in the system, your M2 money supply is going up. Inflation starts to kick up because the money in the system is going up. And then the interest rates follow behind it as bondholders sell bonds because of the real negative rate. And that's why you're seeing the government buy bonds to hold the rates down. They're buying them. They're creating artificial demand for bonds. But at some point, you're going to see the dollar come under pressure. The value of the dollar index will go down because of inflation. They're going to have to raise rates to slow the lending, to slow that on the demand side for homes. But here's the problem. If it's a true supply-demand imbalance and you don't have enough homes in the system, you're going to see home prices rocket higher, and then you're going to see rent prices rocket higher if we can't build fast enough. And that's exactly what we're seeing. Higher home prices, higher rent prices. So we're not building fast enough to meet the demand that's out there. And you're going to have a whole bunch of demand, not enough supply. And from a logical standpoint, if you have to live somewhere, you're going to choose between very high rent prices, or you're just going to buy the house even if it has higher rates, because it's a better buy to lock in your costs than to continue to rent with high rent prices going up. So what you're going to see is you're going to see the dollar drop at the same time interest rates go up. That is the conditions that are going to exist through history. It is ultra rare to see interest rates go up at the same time the dollar goes up. Because if people are flooding into dollars, they're usually flooding into bonds at the same time, which means rates are going down, not up. You've got that kind of backwards, I think. Another thing is real estate goes higher when interest rates go higher. Look at history in expansionary phase of real estate. You're going to see real estate prices go up at the same time interest rates go up. Supply demand is driving it. Yes, homes become less affordable, but affordability does not drive the equilibrium between supply and demand. When there's a large supply-demand gap, homes have to become less affordable to balance the market out. They have to become less affordable. So even though interest rates are going up as we build more and more homes, they are becoming less affordable, but we have the supply-demand imbalance, and they have to become less affordable. Otherwise, if everyone could buy a house, who gets priced out? Someone has to get priced out if you have a large supply-demand gap. So prices have to become less affordable for those to keep the equilibrium of demand and supply in equilibrium, and price being the equalizer. So I wanted to go over that. And right now, what we're lining up for is the beginning of an expansionary phase of real estate. Home prices are going up, inventory is getting drawn down. We have a mismatch between supply and demand. Price is the equalizing factor, and then I guarantee it, we're going to go and build a whole bunch more new homes. That is inflationary. The next step, when the inflation enters the system, which we're seeing, is interest rates will go up because it's going to put pressure on bonds. People think it's transitory, but it's not transitory because it's coming from the real estate market. All the other stuff that they printed and handed out was just icing on the cake. So that might be transitory in that little burst of inflation. It may come down, but the rates will remain elevated. The inflation rates. Interest rates will come higher. And why? What happens when interest rates go up? Now, the existing bonds pay a lower interest rate. If they're paying 2%, but now you can buy a bond at 3%, the existing bond is worth less. The cash flow of the 3% bond that it pays out, the 2% is going to have to equal it. In order for it to equal it, you're going to be down in its price to equal the two cash flows out. So if you do a net present value calculation, those two are going to equal each other out. And whatever pays a less interest rate means that they're going to be sold off. Because I'd rather buy a new bond that pays higher interest than the old one that pays a lower interest. Therefore, you're going to pay less money for the lower interest rate bonds than the higher new interest rate bonds. And that'll continue as rates go up, the existing bonds all get priced lower. All bonds in existence get priced lower. And hopefully that makes sense there. So stocks, when interest rates go up, stocks get priced lower because their PE ratios contract. When people can't find yield in bonds, what they'll do is they'll speculate and go into stocks and buy it because of the dividend yield or because they want to speculate and get some sort of return. The problem is when interest rates go up and your risk-free return on a bond goes up, people are less willing to speculate in stocks and they'd rather buy the bond because you've got higher payments. It's a higher interest rate. So it puts pressure on the stock market to sell off as people rotate money to buy either new bonds. And if the inflation rate's high enough and you've got a large enough real negative rate, they may go straight into precious metals and commodities. And that's what I would do, especially if you think it's going to be a very inflationary environment and if commodities are priced very low. And like I said, with the ratio of commodities to stock ratio or commodity to bond ratio, commodities are vastly underpriced. Vastly. They've never been this underpriced in history. So what I am proposing is that commodities they're going to have a huge bull market over the next probably 10 years because of an expansionary phase of real estate and the inflation that comes with it, because of the valuations of commodities in relationship to stocks and bonds. And interest rates are the things that trigger this movement between stocks and bonds and into commodities and precious metals. It just hasn't happened yet. We are at the beginning of the beginnings. And when that money starts to flow from sector to sector, the commodity to stock ratio is going to change. And commodities will be priced higher in relationship to stocks and bonds. And that's basically the whole thesis of the entire channel. So a couple of things I want to touch on is higher interest rates does not mean a lower housing market. That is a false statement. Higher interest rates does not mean that you'll get a stronger dollar. It may try to promote a stronger dollar, but it doesn't mean you'll get one. It depends on the supply-demand balance in real estate and how much inflation we have in the system. That's what's going to push the dollar lower. Interest rates are going to have to go up to a significant point. And I can't tell you what that point is. It's going to have to go to some level where it becomes significant enough where it slows the money velocity down. It slows people from getting loans, the supply-demand of loans. It slows that all down. And then money will come up in price. But in every expansionary phase in real estate, we've seen the dollar index go down. We've seen home prices go up. We've seen real negative rates. We've seen increasing precious metals prices and commodity prices. And stocks either go kind of sideways to lower. And then we see bonds go down. in an increasing interest rate environment. The interest rates is what rotates all that money. That's the key thing to look at is dollar, because when the dollar starts to drop, you'll see interest rates start going up. So that's kind of our leading indicators. And that's why I always go over the leading indicators of the dollar and interest rates, because I'm looking at how they're interacting, and my outlook is lower dollar, higher interest rates. And I think we're going to see an expansionary phase of real estate continue for a good long time. 2027, 2028, 2029, 2030, somewhere in that range is where the peak will probably be, if I were to take a guess. If you guys have any other questions, put it in the comment section. Hopefully this helps you out. And thanks for putting questions down there. Give me a thumbs up. Thanks for listening. This is Finding Value.